Welcome to Wealth Coffee Chats, folks, for your daily live updates. Get the most out of today's episode by participating in the chat. Make sure you ask some questions, be part of the conversation, have a bit of fun, grab a coffee or a tea, take some notes, and get ready to start your day, folks. Quick few housekeeping rules, though. No spamming, no advertising or self-promotion in the chat. That's not on. Be kind and respectful to everyone when participating. And most of all, have a good time. Real estate investing can be your biggest asset. It also can be your most expensive asset when it comes to getting it right or getting it wrong, folks. It can be time-consuming, stressful, and that's why here at Positive, we have what's called a 6-star team, a full-service team that provides integrated wealth and property investing solutions and services simply designed to help you progress towards your goal of passive income through your property portfolio, folks. Make sure you check out our other podcasts on the Positive Mentor Network. Not only is there Wealth Coffee Chats, there's the Urban Property Investor. Drops every Wednesday with straight talking investing strategies and lessons with Sam Saggers. Property Investor Tales. This is where our clients, you guys, share real life stories from property investing, hosted by some of our advisors and strategists. And that's done every fortnight, dropping every Monday. Wealth, Wine and Wisdom, folks, that debriefs the week that was in the world of finance and property, hosted by yours truly, Jason Witten and Andy Fenton on Fridays. Hey, good morning, folks.
Good morning, everybody. Welcome to another Wealth Coffee Chat.
Hope you're well, folks, wherever you are.
There it is, team. Morning. Morning, wherever you're tuning in from today.
Early bird gets the worm, they say. Here at Positive, we offer a 6-star team. It's a team that help you at every stage of your wealth creation journey.
General advice disclaimer. The information provided and made available through this podcast does not constitute financial advice. The information is of a general nature only and does not take into account your individual objectives, a financial situation, or needs. It should not be used, relied upon, or treated as a substitute for specific professional advice. We recommend that you obtain your own independent professional advice before making any decision in relation to your particular requirements or circumstances. Positive Tax Solutions and its representatives do not warrant the accuracy, completeness, or currency of the information provided on and made available through this podcast.
Good morning, everyone. It's Anthony Wolfenden, Tax Financial Advisor. It's Wealth Coffee Chat time, and we're here to talk a little bit about taxes. And so what I thought I'd share today is some views on principal place of residence, sales, capital gains tax, exemptions, and some exemptions to the exemption that you might want to be aware of. This might be the first part of 2 parts to discuss this because there's a lot of content here. As you're probably aware, when you purchase a principal place of residence, i.e. you purchase a home with the intent of moving into it, and you do in fact do so fairly soon after you've purchased, that asset, handled and managed correctly, is not subject to capital gains tax when you sell it. And there's a bunch of rules around that. If, as an example, you live in that home, you might purchase it. I've got an example that I wanted to work through. In 2014, and you were to live in it the whole time, and you were to sell it in 2025, maybe you purchased it for $500,000 and then you sold it for 1.2 this year, that's a gain of $700,000 on paper, minus some closing costs and some commissions and things that you would have to pay along the way, but roughly $700,000 you'd made. You would keep all of the proceeds. There's no capital gains tax paid on that transaction. Okay, fantastic. So there is actually a 6-year rule. So as a separate example, you could purchase the place for $500,000 in 2014. You could live there till 2015, say, and then move out and even live offshore for 5 years, less than 6 years, maybe move back into the country and then sell the property. It would still be considered your capital gains, your principal place of residence for up to 6 years after you moved out. And you could either move back in or maybe sell it in 2021, say for $800,000, having moved back into it or having sold it before the 6 years is up. And the gain there would be maybe $300,000. Again, it's your principal place of residence. You would not pay any capital gains tax on the sale of that property, and you'd keep the entire gain. You might do something else. You might purchase the property in 2014 for the original example, $500,000. You might move out in 2015. You might be out of the property for 6 years. You could even be living offshore. I certainly did that. You could run the exemption out. So you've been offshore for 10 years. I did that. You could move back to Australia and you could sell the property. In this case, you're resident in Australia. It was your principal place of residence first full year. It's counted as your principal place of residence for the next 6 years. And then after that, the capital gains exemption runs out. You would pay tax on the gain from the 7th year. After the 6 years have run out, maybe the property is worth $800,000 at that point. You'd sell it again in 2025 for 1.2. You would pay capital gains tax on the sort of last, 5 years of ownership, whatever the value increase was. We'll call it nominally $400,000. And that income, that gain, would be discounted and then added to your taxable income and taxed at marginal rates. So if you were earning absolutely no income on the $400,000 nominal gain, you'd pay an average of 14% if you had no other income at the time. And so that'd be about $56,000 in tax, capital gains tax, plus the Medicare levy, 2%. If you had a fairly high income from other sources, then the total capital gains tax would be 50% discount multiplied by the highest marginal rate, 47%. It would be 23.5% of whatever the total gain was. We're counting $400,000 here. So that means your tax total paid on a gain of $400,000 at the back end, you're living here, you're selling the property, moving on, will be somewhere between sort of $56,000 for the income tax portion, and at the upper end, sort of $94,000, 56 to 94 on a total gain of 400, meaning somewhere between 14 and 23.5% of whatever you made in total. All reasonable. You keep over 3/4 of the money that you made, and you're only paying capital gains tax on the back end when it's not your principal place of residence. Now, here's where it gets really interesting. Let's say you have exactly the same scenario. You purchased the place in 2014 for $500,000. You lived in it for a year and then you moved out. Maybe you went offshore, as we mentioned in the previous case. But your choice was to remain offshore. So you blew through the period you lived in it. You blew through the 6-year principal place of residence, 6-year rule. You continued to rent the property out for another 5 years after that, and you decided to sell the property in 2025, just as we had in the previous example. But in this case, you were living overseas. You hadn't come back. You weren't resident in Australia. You were living, working, and having your lifestyle in another country. Some very interesting things happen that non-residents should be aware of. The first is, living offshore, you're subject to non-residency income tax rates that start at 30% on $1 earned. So there's no discounted tiers of income and thus capital gains tax below 30%. The second thing is, rules have changed, and non-residents, even if they own a property individually, even if they're Australian citizens, but they're non-resident in Australia, you do not have access to the CGT general discount of 50% for owning an asset for more than 12 months. And then just to really kick you in the pants, non-residents don't have any principal place of residence exemptions at all. 3 things come back to seriously bite someone who's a non-resident. No discount on the rates of income tax below 30%. No general discount of 50% on capital gains, and no period of exemption for the time you lived in it or it was considered a principal place of residence. So what does that mean? Well, that means the gain is the difference between what you bought it for and what you sold it for. Sold it for 1.2, bought it for $500,000. That's a $700,000 gain. So the gain's big. It's not discounted. You pay a minimum of 30% on it going up to top marginal rates. And you do it from the beginning to the end because there's no period of principal place of residence exemption or anything else. So in this case, on that property that was your home, you're living offshore, on a total $700,000 gain, the tax for capital gains would be $290,350. But there's no Medicare levy because you're not resident. So there's a little bit of a saving there. So what that means is being non-resident has increased the tax at the minimum amount of tax payable in this case has gone up by almost $200,000. If you remember the previous example, the capital gains was between 14 and 23.5% on just the last part of ownership, meaning you might pay tax of $56,000 to $94,000. In this case, capital gains tax is $290,350. So there's about $200,000 extra tax because you're non-resident when you sell, as opposed to coming back and being resident instead. So what should you do if you're a non-resident? Number one, be very careful owning assets in Australia. Number two, certainly plan before you sell them. Capital gains tax is triggered when you sign a contract to sell, not when you get the proceeds. And number three, if you've made a massive gain, maybe you should move back here and be tax resident, again, not when you settle, but when you sign the contract. And it's the residency, it's not where you're living at the time. You must be considered tax resident at the time you sign the contract for sale. So you can't just move back and go, I'll live here the next 6 months and I'll sell the property today. That probably wouldn't pass muster. But the consequences are massive. So I share that so you can make good choices. This is interesting. There's also some interesting things that go on with capital gains tax in the last house you live in before you pass, and that will be a subject for another day. That's it for tax time this week in Wealth Coffee Chats. Happy owning, don't sell non-resident.
Thanks for watching another episode of Wealth Coffee Chat, folks. Make sure you like, subscribe, and turn on your notifications so you never miss a thing when we go live. Improve your portfolio and investing game, folks, with Wealth Coffee Chats live every morning at 8:10 each weekday. Make sure you join us. Previous episodes are also available wherever you get your podcasts, folks, as well as our other podcasts from the 6-Star team here at positivementor.com.au.